In this video, I'm going to teach you one of the most powerful setups that nobody talks about. And once you see it, you'll never miss the biggest moves in the market again. Here's my latest live funding account stats applying these fundamentals. If you want to follow along in real time, I'm going to post every single trade on my recap channel. But first, what's our goals for this video? Number one, to understand the concept that nobody knows. Number two, to enter trades with confidence and precision. And finally, be able to pass your first funding account. So let's get into it. Okay, step one, this is a must. Before we do anything, we must figure out our market bias. Are we bullish, looking for longs? Or are we bearish, looking for shorts? Now to do this, we need to mark the session highs and lows on the 15-minute time frame, and the way they work, if price sweeps a session high, we're going to frame a bearish condition, and if price sweeps a session low, we're going to frame a bullish condition. Now you can mark all your session highs and lows manually, or you can head on over to TradingView.com and search in the indicators tab ICT kill zones and pivots by trade for op. This will just make sure that you have all the correct session highs and lows on your chart. Now for this model, I'm going to be trading NQ on the 1 minute time frame. And this is a momentum based model. So you want to trade the most volatile period of any given asset. And since this is NQ, we want to make sure that we're trading in the most volatile periods, which is going to be at New York Open. That is at 9:30 a.m. UTC -5. New York session would have just begun, and now NQ is going to be volatile. Now this system does work for many different assets on the futures market. Just please make sure it's the most volatile period, or you're not going to get the best results. Now, because we want the most volatile periods, we want to be trading NQ within macro windows. Now, macro windows are the first 15 and last 15 minutes of every single hour. Only a few of them are high probable depending on your asset. NQ has two major macros in New York session. One is 9:45 till 10:15. This is called the first AM macro. The other one is 10:45 till 11:15. These are going to be the windows that we can look for trading opportunities, not 1 minute before or 1 minute after. It has to be in this 30-minute interval for this model to be the highest volatility. This just ensures when we are trading, liquidity and momentum are at their strongest. So now this is how it's going to look on the 15-minute time frame. Your session highs and session lows are going to be clearly visible on the chart, and all we need to do now is wait for price to sweep a high or sweep a low and look to frame that bullish or bearish condition, which we see price came down, swept London low, Asia low. So coming into market open now, we're going to frame a bullish continuation until London highs has been swept. That is it. Our bias is now bullish until the opposing session high has been swept. Once our bias has been confirmed, in step 3, we're going to drop down to our entry time frame, the 1 minute chart. And here, we're just going to wait for price to pull back into an onside fair value gap. Now, a bullish fair value gap is a 3 candlestick pattern with candle 3 wick low and 1 wick high. Don't touch or overlap, giving us that strong support level. In a bearish sense, it's the opposite. Candle 1, 2, and 3. Candle 1 wick low and 3 wick high. Again, don't touch or overlap, giving us that resistance. So because we're bullish in this example, we need to find a bullish fair value gap. Where's the most recent one? Well, reading price from right to left, we have 1, 2, 3 candles. Candle 1 wick high and 3 wick low. Don't touch or overlap. So we're looking for price to pull back into this level and hold as support. This is not our entry model, but we want confirmation that buyers are willing to suppress price moving lower, and they are holding it as a line of defense. Exactly like this, price is now pulled back into the fair value gap, and it's closed using it as support. Step 4, this is going to be our entry model, the FPVI, the first presented volume imbalance. Now this does get a lot more advanced, so please rewatch this as many times as needed to truly understand this concept. But after price pulls back to the most recent fair value gap, we're looking for a momentum-based entry utilizing volume imbalances. Now, for those of you that don't know, a volume imbalance is simply the difference between two consecutive candles. In a bullish sense is where candle 2 opens higher than candle 1's close. We're going to exploit that very small inefficiency. In a bearish sense, we have two candles here and candle 2 opens lower than candle 1's close. That is all it's going to be, and that is what we're going to use to enter a bearish condition. Now, because we're bullish, we want to find the first presented volume imbalance. So once candle 2 closes, the way we're going to enter into the market is we're going to place a limit at candle 2's open as the market looks to rebalance the inefficiency before continuating higher. Now, in terms of stop losses, you have the swing low or the first consecutive candle that was part of this volume imbalance. Both work, but I want you guys to really refine your edge with your target at a first basis point of a 1-to-1. So if we risk $1,000, your first take profit or your break even point will be once you're up $1,000, and your second target can be the opposing session high, or you can trail one candle behind. So this is how it's going to look. You're going to place a limit at candle 2's opening price, stop loss underneath candle 1's wick low, first target or break even point at a 1-to-1 risk to rewards. Now you've been filled into your position. Target 1 has now been hit. You can move your stop loss to break even or trail one candle behind. I want you guys to really test which works best. I personally prefer a static target versus trailing, but I know some of you love to let runners run. So now we move the stop loss, keep trailing as price moves higher until you eventually get stopped in profit. Now this would have made you, if you trailed, around $1,700, risking $1,000. Now, if this was confusing, we are going to go over some real live examples. But before we do so, make sure you hit subscribe so you don't miss any more strategy like this. It only takes a second and it really helps me keep making content. So in example number 1, we're looking at the price chart of M&Q on the 15-minute time frame. The date is the 2nd of January 2026 and our session has just begun. So the first thing we want to do is see which sessions have been swept and which one was most recent. So in this given day, I can see that London highs was swept here, Asia previously, and London and Asia lows are still intact. So our bias coming into this session is bearish. So let's drop down to the 1 minute. Now we need to make sure that we're in a macro. Okay, 9:45 has just begun. So what we want to do now is wait for price to pull back to an onside fair value gap. Well, in this instance, we're looking for bearish gaps. But price has recently inverted one bearish gap here. So we want price to create a new leg and a new bearish gap to enter into that short position. So let's keep pressing play. Okay, we're re-sweeping the London high sweep. Now what we want to do is price to create a bearish fair value gap. Like so. So now we have an onside bearish gap. We are looking for a bearish continuation. So what we need to see next is price pull back into this bearish fair value gap. We can see we have 1, 2, 3 candles, the third candle wick high here and the first candle wick low. Don't touch or overlap, giving us that bearish fair value gap, also a high probable resistance level. So next step, we want to see price pull back, use this as a resistance, like so. And now we can look for our entry model. So our entry model into a bearish continuation is a volume imbalance. A volume imbalance that we're looking for is 2 consecutive onside candles. So I want to see 2 bearish candles with a volume imbalance between the 2. So there was a volume imbalance here, but it closed bullish. That's why you have to let the candle close. Now we have 1 bearish, another bearish, Okay, right back into the bearish fair value gap here, using it as resistance again. And now we have two bears. So we need to analyze if there is a volume imbalance. No, these candles have closed and opened perfectly. And then here is our volume imbalance. We have one candle, two candle. The second candle has opened lower than the first candle's close. That small little inefficiency is our entry model. It's a fantastic signature. The momentum is going to step in. The way we approach this, we place a limit directly on the candle open here. Stop loss above the beginning volume imbalance is two candles, so you can put it above the first. Place a limit. We'll use 13 contracts. Let's put it to 20. 20 contracts sell. So once that gets filled, we'll place the stops. Okay, we've now been filled. Move your stop loss to where it should be, risking $1,000. And our objective is the opposing session low. So we're looking to target London low. You guys definitely don't need to start out with that. You can go for a 1-to-1 and then work on extending your targets. But I definitely recommend going break even at a 1-to-1 still. But we're going to drag that all the way to London low here. Around a 4.6R multiplier. So risking 1,000 to make 4.5. Break-even point, let's just try and find that. You know what, we'll let price play. Okay, so that's roughly a 1-to-1. Yeah, we're at 1.2K. The next objective now, I would personally just move to break-even. I don't like trailing my position, but I'll show you what it looks like to do so. So now you could trail one candle behind. So it would look like this for those of you that want to trail and just secure profits. Perhaps you trade an Apex account. You know how they are with their rules. So you can keep following it down. Candle by candle, you're just locking in the profits here. And one final push. You've locked in 2.8R. If price was going to reverse, you would have secured at least some of your position. Your final target would have been hit for around a 5R multiplier. So that is it for today's video. Go ahead and join my Discord in the link in the description. And make sure to subscribe so you never miss another video.